Jake picks an actively managed fund. Marcus buys an index fund. Both think they've just made the smartest decision of their lives. Both are wrong. One forgot to account for probability. The other forgot to account for the power of compounding. And when we run the numbers over 20 years, the gap will make you want to go back and look at your own portfolio. Let's keep this fair. Jake and Marcus are both 30. Both earn $55,000 a year. And both just saved $50,000. The only difference is what they do with that money. Jake opens a brokerage account, reads a few online analyses, hears a friend brag about a 30% gain last year, and decides to invest in an actively managed large-cap stock fund. The kind with a professional management team, deep research, and a promise to beat the market. He also spends time picking a few individual stocks he believes are bargains the market has overlooked. Marcus takes that exact $50,000, puts it into an index fund tracking the S&P 500, sets up an automatic transfer of $300 a month, and almost forgets the account exists. On day one, Jake feels like he's in control of the game. He checks the ticker every morning. He has a story to tell whenever he catches up with friends. This fund just rose 3%. That stock he bought right at the bottom. His friends nod along, ask a few more questions, and some even ask for advice. Marcus has nothing to tell. His account is just a number sitting still. No dramatic swings, nothing to brag about. When coworkers ask what he invests in, he says an index fund. They nod politely and change the subject. No one's impressed. But feeling and math are two completely different things. By year 3, the data starts to speak. According to the Spiva report, the most authoritative research on actively managed fund performance versus the index, in 2025, as many as 79% of actively managed U.S. large-cap stock funds underperformed the S&P 500, worse than 2024, when that figure was 65%. This is the 4th worst year in the report's 25-year history. Looking at Jake's actual year-by-year performance makes this clearer. In year 1, his fund and the stocks he picked himself returned 10%. He felt like he'd chosen correctly. In year 2, the number was even more impressive, 12%. Jake was convinced he was beating the market. But in year 3, the market reversed. The stocks he'd been proudest of turned lower. He cut losses on part of his position, bought into a few other tickers to make it back, and the year ended almost break even. Averaged across the 3 years, Jake's return comes out to about 8% per year. Not bad, even close to the market's long-term growth rate. But that 8% doesn't fully capture what actually happened. To get there, Jake had to buy, sell, and cut losses multiple times over 3 years, every time the market swung hard, every time a stock missed expectations. And every trade came with a cost, transaction fees, the bid-ask spread, and for stocks held under a year, short-term capital gains tax, which is taxed far higher than long-term gains. Marcus had no story to tell over those 3 years. No cutting losses, no scrambling to break even, no trading. After 3 years, Marcus's account, starting with $50,000 plus $300 a month at a net return of about 9.5% per year, has grown to roughly $76,000. Jake's account, with the same starting capital, but with his nominal 8% average return further eroded by trading costs and short-term taxes, nets out to only about 6.5% to 7% per year, landing around $68,000 to $70,000. The gap isn't large yet, but it has started. And it started from the very actions Jake believed were helping him stay in control of his investment. After 3 years of moving in and out of the market, Jake didn't conclude, "I'm trading too much." He concluded the opposite. "I need to be more attuned to the market." He started reading financial news every morning. The Fed's interest rate moves, inflation, oil prices, and talking like a professional investor. The Fed's about to cut rates, so I'm rotating into tech. Inflation's cooling, so I'm selling off some of my energy holdings. But the market isn't a single variable equation you can solve by reading one headline correctly. It has dozens of variables at once. Interest rates, inflation, geopolitics, crowd psychology. And no one, not even funds with hundreds of full-time analysts, knows for certain which variable will dominate next month. Jake is trying to solve a problem that even the highest-paid professionals lose at 89% of the time, compared to doing nothing, according to Spiva, at the 5-year mark. This produces one specific, recurring kind of loss for Jake. He buys a stock with solid fundamentals, but it trades sideways for 8 months, while another sector runs hot. Impatient, he sells to rotate into the hot sector. 2 months later, the old stock suddenly spikes on news nobody saw coming, while the sector he just jumped into starts cooling off. He doesn't lose because his analysis was wrong. He loses because he sells right when the market was about to reward the patience he didn't have. This is exactly what Dalbar documents at the scale of millions of investors. In 2024, the average equity fund investor earned only 16.54%, while the S&P 500 gained 25.02%. That 848 basis point gap comes from selling during downturns and buying back after the recovery. Or, as in Jake's case, selling an asset right before it turns. The average fund holding period in 2024 was just 4.79 years, less than half of a typical market cycle. Marcus has a completely different experience over these 5 years, not because he's smarter, but because he has nothing to decide. His index fund also goes through stretches of frustratingly slow growth, and he's had the fleeting thought, maybe I should try individual stocks like Jake. But because his $300 automatic transfer runs every month, and because he doesn't open a trading app every day to be tempted, that impulse passes without turning into action. This is the single biggest advantage of systematic investing. It removes the opportunity for emotion to intervene in the decision. After 5 years, the gap between Jake and Marcus is no longer driven mainly by management fees. It comes from the very corrections Jake believes are optimizing his portfolio. By year 10, everything has diverged. Exhaustion. Not from losing money repeatedly. Overall, the account is still up, but from having to keep making decisions in a game where he's never certain he's right. Every Fed meeting, every new inflation report, every oil price swing tied to some event somewhere in the world, he has to ask himself, should I adjust the portfolio? And every adjustment, right or wrong, comes with a trading cost, sometimes with short-term capital gains tax if he hasn't held long enough. Marcus, with $50,000 to start, plus $36,000 contributed over 10 years, $86,000 total, at a net return of about 9.3% per year after low fees, has roughly $178,000 to $185,000 in the account. Jake, with the same contributions, but paying about 0.6 percentage points more in fund fees each year, plus accumulated losses from mistimed trades and short-term taxes, about 1 to 1.5 percentage points a year, according to Dalbar data, is effectively growing at a net rate of only about 6.5% to 7% per year. After 10 years, his account sits between $145,000 and $152,000. The gap? Roughly $30,000 to $40,000. Not because Jake is foolish, and not because he misjudged the fundamentals of any particular company. It's because he placed a bet in a game whose odds of winning keep shrinking over time, then played that game exactly the way human psychology reacts to uncertainty. Fear when prices drop, impatience when prices stall, excitement when another sector runs hot. If I only showed you the downside of active investing, I'd be biased. To be fair, Let's look at the very stocks that stock-picking advocates always point to. If Jake, instead of jumping from ticker to ticker, had picked and held a few stocks like Apple or Amazon for 20 years, the outcome would look completely different. Apple delivered a total return of over 16,000% over 20 years, equivalent to a compound annual growth rate of about 29% a year. $10,000 invested in Apple 20 years ago would be worth more than $2.7 million today, compared to only about $49,000 if invested in the S&P 500 over the same period. Amazon is even more impressive, with a compound annual growth rate of about 30.5% per year. But the real question isn't, did these stocks deliver outsized growth? Clearly, they did. The question is, could you have actually held them the whole way? During the 2008 financial crisis, Apple lost more than half its value, falling nearly 60% from its peak at one point. Amazon also fell about 60% over the same period. If your account lost half its value in just a few months, would you have the nerve not to sell? Most investors don't, which is exactly why Dalbar consistently shows the average investor underperforming the actual returns of the very stocks they hold. Amazon repeated that pattern in 2022, falling nearly 50% in a single year on inflation and interest rate fears, becoming the first company to lose $1 trillion in market value. Even Apple, one of the most stable companies around, fell more than 26% that year. But human psychology isn't built for that. Fear of losing money is always stronger than hope for a future that hasn't happened yet. Picking the right stock is only half the equation. The other half, and the harder one, is holding on to it through the exact stretches when every instinct tells you to sell. There are years when active investing genuinely shines. In 2024, only 29.7% of small-cap active funds underperformed their benchmark. Not because managers got better, but because they tilted toward larger-cap stocks to catch that year's trend. In less efficient markets, like emerging market bonds, active management still has a real chance to outperform. Research on persistence shows a fund that outperforms 1 year rarely holds that position 4 years later. Mostly luck against variables no one could foresee, not a repeatable skill. If Jake had iron discipline, buy and hold, don't panic when a stock drops 50% in a crisis, he could close most of the behavioral gap. But the gap from fees and statistical probability remains, because it comes from the structure of the game, not from behavior. By year 15, the data leaves no room for debate. Across all 22 U.S. equity fund categories and 16 bond fund categories, not a single one has a majority of active funds outperforming their benchmark over 15 years. Not one. Jake, after years of trying to read every macro variable correctly, gradually realizes something. Every time he felt most confident, "This time I'm definitely right," was usually when the market moved against his expectations. Not because he understood less than others, but because the market reflects the expectations of millions of people at once. And by the time information is clear enough to be definitely right, the price has already priced it in. This is when Marcus's compounding truly starts to accelerate. The gains on his gains now generate more new wealth than his monthly contribution itself. His account, with total contributions of about $104,000 over 15 years, has grown to roughly $310,000 to $330,000. Jake, with the same contributions but higher fees and years of accumulated behavioral losses, sits at around $235,000 to $250,000. The gap now exceeds $70,000 to $80,000. And it's widening faster every year. Not because Marcus is doing anything more, but simply because he isn't doing anything at all. After 20 years, 93% of active large-cap funds underperformed the S&P 500. That's no longer a risky bet. It's a bet where the odds of losing were nearly certain from the start. Not because fund managers lack skill, but because they're trying to solve an equation with too many unpredictable variables, all while paying fees and taxes every time they try to solve it again. Marcus, with $50,000 to start, plus $300 a month for 20 years, $122,000 in total contributions at a net return of about 9.3% per year, has roughly $460,000 to $490,000 in the account. Most of that number, more than $300,000, comes from compounding, not the money he put in. Jake, with the same contributions, but higher fees and average behavioral losses of about 1 percentage point a year, is growing at a net rate of about 7.5 to 8% per year. After 20 years, his account sits between $340,000 and $370,000. The final gap, $100,000 to $140,000. Not because Jake lacks financial knowledge. In fact, he understands macroeconomics, interest rates, and markets better than most people. The problem is that this understanding convinces him he can predict a system with too many variables at once. And every action taken on that belief comes with a cost, whether he's right or wrong. Marcus didn't beat the market. Marcus simply didn't lose to it by never having to answer the question, should I act right now? And it turns out, that's the stronger strategy. That doesn't mean every active fund manager is useless, or that following macro trends is pointless. There are managers who are genuinely skilled, who genuinely outperform year after year. The problem is that the odds of picking the right one and correctly calling the macro variables that will drive the market for the next 20 years are close to zero, even for people who do this full time. If you still want to keep an active component in your portfolio because you believe in a specific strategy or want exposure to less efficient markets like small caps or emerging market bonds, the sensible approach is to keep that allocation small, watch fees closely, and most importantly, don't sell an asset just because it's growing slower than you expected, because that's exactly the behavior that costs the average investor 848 basis points in a year the market goes up. Jake and Marcus both went into this thinking they were doing the smart thing. Jake believed that the more he understood macro trends, the more closely he tracked the Fed, interest rates, inflation, and oil prices, the bigger his edge. Marcus believed in doing nothing and letting time do the work. Neither of them actually sat down and asked, can a system with dozens of variables at once be predicted correctly, consistently, over 20 years? The trap isn't choosing active or passive. The trap is believing that knowing more about the market means predicting the market more often, when 25 years of data show the opposite.